Hey everyone, and welcome to this Maury Classes Explainer. We're going to be breaking down everything you need to know about accounting standards. So let's just dive right in, shall we?
All right, so here's the game plan for today. We're going to cover what these standards actually are. Then we'll look at how they're even made in the first place. After that, we'll zoom out to the global context with something called IFRS, see where India's journey fits into all this, and wrap it up with the IND-AS roadmap. It's going to be a packed one.
Okay, so let's get down to the big question. What are accounting standards really? Well, to get to that, we've got to start with a foundational rulebook that, kind of governs all financial reporting.
That rulebook, it's called Generally Accepted Accounting Principles, or GAAP for short. Think of it as the shared language of business finance, the set of rules and procedures that every company has to follow when they're putting together their financial statements. But here's the thing. GAAP isn't just some single dusty old book. Nope. It's actually a mix of official standards set by the big policy boards and, well, the everyday, commonly accepted ways of doing things.
Now, if you look at the global stage, the big name you'll hear is IFRS. That's International Financial Reporting Standards. But right here in India, we do things a little differently. We have our own specific standards. You'll hear them called accounting standards, or AS, and the newer ones that are more aligned with the global view, those are Indian accounting standards, or IND-AS.
So let's zoom in on India's accounting standards, or AS. What are they? Well, at their core, they're official policy documents from the government. And they basically cover the 4 pillars of accounting: how you recognize a transaction, how you measure it, how you present it, and what you have to disclose about it. It's the whole shebang.
And this is exactly why we need them. I mean, think about it. These standards make sure everyone is playing by the same rules, right? It puts all companies on a level playing field. They also demand more transparency, which is absolutely crucial if you're an investor. And maybe most importantly, they let you actually compare the financial statements of 2 different companies, apples to apples. This seriously cuts down on the chances for any, let's call it, creative accounting.
So you might be wondering, who actually comes up with all these rules? Is there some secret committee somewhere? Well, not so secret. In India, that huge responsibility falls on the shoulders of one key organization, the Accounting Standards Board, or ASB.
And believe me, the ASB doesn't just whip these things up overnight. They have a really thorough step-by-step process. First, they spot an area that needs a standard. Then, they put together a study group to hammer out a first draft. That draft gets sent around to all the important regulatory bodies for their 2 cents. After that, they release what's called an exposure draft to the public. This is a huge deal for transparency because anyone can comment. Finally, after sifting through all that feedback, the ASB finalizes the standard, it gets a final once-over from the ICAI Council, and then, boom, it's issued.
Okay, so after all that hard work, what's the grand total? How many of these standards are we actually talking about? Well, originally there were 29, but a couple got withdrawn over the years. So today, that leaves us with a grand total of 27 effective accounting standards here in India that companies have to follow. 27.
And you can actually group these 27 standards into a few key buckets. You've got 7 that are all about presentation and disclosure, then another 7 that are asset-based, there are 2 for liabilities, 2 for revenue, and then the last 9 kind of cover a bunch of other specific important areas.
All right, let's pull the camera back a bit. Let's zoom out from just India and look at the whole world. I mean, we live in a totally globalized economy, right? And having a different set of accounting rules for every single country, well, you can imagine that creates a ton of confusion and problems. And that's exactly where IFRS steps in.
So why do we even need global standards? The reasons are honestly pretty compelling. Just think about it. It makes it so much easier for an Indian company to get funding from investors in, say, London or New York. Why? Because those investors can actually read and trust the financial statements without needing some kind of special decoder ring. When everyone's speaking the same financial language, you get this amazing uniformity and transparency. It helps money flow freely across borders, and just as importantly, it helps cut down on a lot of expensive mistakes.
Now, this whole idea of a single global standard didn't happen overnight. It's been a real evolution. It all kicked off way back in 1973 with the creation of the International Accounting Standards Committee, or IASC. Then, in 2001, it got a major upgrade and was restructured into what we now know as the International Accounting Standards Board, or IASB. And that's the group that issues the IFRS we see being adopted all over the globe today.
So, with this global wave happening, India was at a crossroads. We had to make a big decision. What was our strategy going to be? How are we going to align our own accounting language with what the rest of the world was speaking.
Basically, a country has two main options here. You can go for adoption, which means you just take the IFRS rules word for word and use them as is. Or you can choose convergence. This is where you develop your own high-quality standards that are mostly aligned with IFRS, but you make a few tweaks for your local situation. In India, we chose convergence. So why do that? Well, it really gave us the best of both worlds. We got that crucial global alignment, but we also kept the flexibility to adjust the rules for India's own unique economic environment and legal system.
So because of this convergence approach, our standards, Ind IS, are almost a mirror image of IFRS, but with a few important differences. You'll hear these terms carve-outs and carve-ins. A carve-out is basically where we've deviated a little from an IFRS principle because we had to make it work for Indian economic conditions. And a carve-in? That's where we've actually added extra guidance into Ind IS that you won't even find in the original IFRS, just to provide a bit more clarity.
Okay, so the decision was made, convergence it is. But how do you actually roll out such a massive change across the entire country? You can't just flip a switch. It wasn't a big bang event. Instead, it was a super carefully planned, phased implementation. So let's take a look at that roadmap.
For most companies, the journey started on April 1st, 2015. That was the voluntary phase. Basically, any company that wanted to could make the switch to Ind AS. After that came two mandatory phases, one kicking off in 2016 and the next in 2017, and these were designed to bring all the larger companies on board.
So, what decided who had to switch in and when? It all came down to a company's net worth. The value of what it owns minus what it owes. In Phase 2, which started in 2016, it became mandatory for any company with a net worth of 500 crore rupees or more. Then, just a year later, Phase 3 kicked in and roped in all the other listed companies, plus any unlisted ones with a net worth over 250 crore.
And this brings us to a really important rule. There is no going back. Once a company makes the switch to Ind AS, doesn't matter if it was voluntary or mandatory, they have to stick with it for all their future financial statements. It is absolutely a one-way street.
Now, what about other financial institutions? Well, the roadmap was a little different for them. NBFCs, for example, had their own phased rollout in 2018 and 2019, but they weren't allowed to jump in early. And for banks and insurers, for them, the whole thing has been put on hold, deferred till further notice. It's because their finances are so complex, with unique financial instruments and global capital rules, so the regulators are still figuring out the best way to do it.
And there you have it. That's our whirlwind tour of India's accounting standards. From the big global ideas to the specific local rules, you should now have a really solid foundation for understanding how this whole world of financial reporting works.
This explainer was brought to you by all of us here at Mori Classes. Hey, if you found this helpful, do us a favor and share it with someone who might need it. And of course, don't forget to subscribe. We really do love hearing your feedback, so drop a comment below. It leaves me with one final question for you. As business gets more digital, more global every single day, what do you think the next big challenge for accounting standards is going to be? Something to think about. Thanks for watching.